ServiceNow Executive Summary, a fallen angel or a value trap. Company Overview. ServiceNow, founded in 2004 and headquartered in California, is a leading provider of cloud-based digital workflow solutions. The company offers a comprehensive suite of products designed to improve the efficiency and productivity of organizations across various industries, including financial services, healthcare, manufacturing, public sector, retail, and telecommunications. ServiceNow's platform features AI-powered applications that facilitate the automation and integration of workflows, assisting companies in managing IT services, operations, security, and customer service. The company's flagship product, the ServiceNow AI platform, is a cloud-based solution that enables seamless workflow automation and digital transformation. ServiceNow primarily generates revenue through subscription services, which account for approximately 97% of its income, with the remaining 3% from professional services. The company serves over 8,800 global customers, including more than 85% of the Fortune 500. It continues to expand its offerings through strategic acquisitions, enhancing its platform capabilities, and addressing the evolving needs of enterprises in the AI and digital transformation era. Price action and technical context. After peaking at $239 in late January 2025, Now suffered a punishing 59% drawdown that bottomed out around $99 during the week of February 23, 2026. This collapse was defined by two primary waves of selling, beginning with a rotation-led drop to $135 following the DeepSeek shock and culminating in a second leg down to $99 fueled by SaaSpocalypse, fears regarding AI cannibalization. Although the stock has since bounced to approximately $120, it remains 50% below its all-time high and continues to trade well under its historical support levels. This technical damage is mirrored in its relative strength, as the stock's performance against the S&P 500 plummeted from the 22nd percentile in late 2025 to the first percentile today. Currently underperforming almost every other constituent in the index, Now has reached a point of extreme divergence that signals either a total capitulation washout or a permanent structural break in the business model. SaaSpocalypse. The core of the bear thesis rests on the fear that AI agents will eventually replace traditional seat-based subscriptions, effectively dismantling the pricing power that has long sustained the SaaS industry. This narrative gained significant momentum in February 2026 following a viral report from Citrini Research, which triggered a massive sector-wide wipeout and sent major players like CRM, WDAY, and Now to fresh 52-week lows. In contrast, bulls led by analysts from Dan Ives, BTIG, JP Morgan, and HSBC argue that enterprise software giants are actually the primary integrators of AI rather than its victims. Proponents of this view point to Now's agentic AI platform and its strategic acquisition of Moveworks as evidence that the company is well-positioned to capitalize on this transition. This fundamental debate remains unresolved and continues to be the primary driver of the current market uncertainty. Fundamentals still excellent. The business is doing fine, actually accelerating on beats in recent quarters. Revenue has grown consistently at approximately 20% plus, and EPS beats have been very strong. The stock has derated, not deteriorated fundamentally. Analyst sentiment. Despite the significant price volatility, Wall Street remains overwhelmingly optimistic, maintaining a consensus buy rating even as price targets undergo aggressive revisions. The average price target has been adjusted downward from the previous $220 to $230 range to a more conservative $175 to $185, reflecting the current sector headwinds. While the majority of analysts still see substantial upside from the current $120 level, KeyBank stands out as a notable contrarian with a sell rating in a target of $115. This clustering of bullish outlooks suggests that most of the street views the recent sell-off as a valuation reset rather than a permanent loss of the company's growth engine. Insider activity. In a strong display of internal confidence, CEO Bill McDermott made a high-profile $3 million open market purchase of stock on February 27, 2026, a move that was publicly reported as part of a coordinated message to the street. This bullish signal was further reinforced as multiple executives took the unusual step of canceling their pre-planned stock sales throughout February 2026, suggesting the leadership team views current price levels as an attractive entry point. While large RSU awards were also issued during the February to March window, these remain a routine part of the company's compensation structure and do not carry the same weight as the direct market buying and the pausing of scheduled sell-offs. Options flow, no clear consensus. The options flow reflects a marketplace that is deeply divided, with significant capital committed to both sides of the recovery debate. Recent activity highlights large bullish sweeps in the September 2026 $115 calls, totaling nearly $800,000, which suggests a targeted bet on the stock stabilizing and recovering above that level by late next year. Conversely, a bearish, long-dated hedge has emerged through the January 2028 $130 puts, representing a deep-in-the-money position for those bracing for a prolonged downturn. The June 2026 $130 call remains the most heavily traded contract by a wide margin, acting as a primary battleground for traders positioning around the stock's ability to reclaim that specific technical level. Ultimately, the lack of a dominant trend in the options market confirms that sophisticated investors are just as split as the analysts on whether this is a bottom or a structural break. Bottom line, the stock currently finds itself in the throes of a severe downtrend, having surrendered 50% of its value from previous peaks. While the price action is attempting to carve out a floor near rock bottom relative to its S&P 500 peers, the technical damage is undeniable. This collapse appears to be driven by a broader SaaSpocalypse narrative, a sector-level fear that AI might eventually cannibalize traditional SaaS models. This unresolved debate has created a massive rift between the company's actual performance and its perceived future viability. Remarkably, the underlying fundamentals remain exceptionally robust, showing no signs of the decay suggested by the share price. The company continues to deliver consistent revenue growth of over 20% alongside significant EPS beats, including a massive plus 45% beat in Q2 2025. This strength is mirrored by a significant $3 million open market purchase by the CEO, a notable bullish signal that suggests leadership views the current valuation as a major dislocation. While analysts have lowered their price targets to the $175 to $185 range, the consensus remains firmly bullish, even as the options market stays indecisive. The core investment thesis now hinges on a singular question: is the AI replaces SaaS threat a structural reality or a temporary sentiment-driven panic? If the bear case is overblown, the stock represents a rare opportunity to buy a high-growth engine at a massive discount. However, if the narrative holds water, those strong fundamentals will eventually roll over to match the price action. For now, the numbers suggest a fundamental powerhouse being crushed by a narrative that has yet to show up in the financial statements. Thank you for your attention. Disclaimer: this content is for informational purposes only and does not constitute financial advice. All opinions expressed are my personal views. Always do your own research and consult with qualified professionals before making investment decisions.